Today, traders, we will be going through 3 different types of entries in Forex trading. Lovely traders, welcome back to ChrisFX. I hope you're doing great, both in life and in trading. Before we begin with the video, I'm not a financial advisor, nor am I telling you what to do or what not to do. Whatever you do is purely your own responsibility and I take no responsibility for your actions. Without any further ado, let's begin with our video. For our today's video, guys, I'm going to be using AUD USD and I will be explaining the 3 types of entries that you can take after a flag pattern is being formed. So first and foremost, as you can see here, I have a graphical representation of the high of a candle, the open and the close of the candle, and I made this drawing in order to show you the 60% rule. Here you can see I have written down the 40%, which is the 40% from the bottom or the 60% from the top for the bearish candles and the exact opposite for the bullish candles. So when I'm referring to the 60% rule, this means that for a short trade we would be entering exactly here by measuring the candle with our Fibonacci tool. So let's move forward. And here, guys, we can see we have our first example. We have price moving above the 50 EMA. We have a clear uptrend and we have a flag pattern being formed, which I'm drawing with 2 parallel lines, as you can see. So we have the breakout entry, guys, that you can see over here where we are entering immediately after the break of this flag pattern, or you can enter immediately after the break of the previous resistance level. When I'm referring to the previous resistance level, this is the previous resistance level. And this, as you can see here, guys, is a fake out. So this is one of the disadvantages of entering immediately after the breakout of the flag pattern, because you do not know when it's gonna break. So let's take this scenario that you would be entering right here because you thought that this candle was gonna continue to the upside. This would be the perfect fake out. So let's check it out. As you can see, I have zoomed in right here. This would activate your trade immediately. And then where would you be placing your stop loss? Most of you would be placing the stop loss right here. So look what the banks did. They came out and hit all the stop losses because they know exactly how us retail traders are trading. Okay, guys, so you saw the example, the first example of the breakout entry, how it is riskier. And here, as I indicate, it would be way safer to enter over there, but we miss part of the movement. A disadvantage, guys, is that we will be entering in a place where the stop loss is gonna be higher, but if we enter right here, then we have a way tighter stop loss and still we have caught more of this movement. And there is no reason to place the stop loss below this wick, as I indicate, since the price is probably never retracing below this wick. The reason for that is, as I said, I believe that this was the first fake out. Many trades from the retail traders were activated right here, and most of retail traders had their stop losses below the previous area. So the banks went and hit the stop losses and then price disappeared. Okay. So there's no reason if we enter immediately right here or even here to place our stop loss below this wick. I don't think price is retracing back once again. So let's move forward to the other entries where we see that retest never happened, but let's check out the 60% rule. And as we can see here, we would have been activated with the 60% rule. So here, either we measure 40% from the top or 60% from the bottom because it's a bullish candle. So let's see, guys, why we did not enter right here. Why don't we measure this candle that I'm indicating right now and we measured the other candle only for the 60% rule? The answer is very simple. The reason for that is that this is the candle which broke the previous resistance area, the previous resistance level, and this is why I'm measuring this candle. Second example here, as you can see, again we have an established downtrend, here we have the flag pattern, and here we have the breakout candle. I'm drawing 2 parallel lines once again. This is the previous support level, and this is the safe breakout entry as we showed earlier. After the previous support level was broken, we are entering with momentum and we are pretty safe that price is going to be continuing. And furthermore, this is an indication that price did not find support once again in the previous area. What about the retest trade? As we can see, the retest would have never happened once again in this example. And here we measure the 60% rule and we see that the 60% rule would not have worked because we would have never been activated into the trade. So here only the breakout trade would have worked in this occasion, and it would have worked very nicely also. Let's move to the third example. Again, we have an established downtrend, as we can see over here, our beautiful flag pattern, okay, the parallel lines that we draw, the support level, and here we have the breakout entry, as you can see, which is after the break of the previous support area. Here we have the retest entry, and we would be placing a sell limit order for that, guys. As you can see, I wouldn't wait for some kind of extra confirmation. It doesn't give any statistical advantage in my backtesting at least, so I would be entering with a sell limit order. And let's check out now the entry number 3, which is the Fibonacci, the 60% level of the candle that broke out this area. We measure only this candle and we see that 60% rule would have worked perfectly. All 3 entries would have worked in this occasion, but the entries are slightly different. And the best entry point would be given from the sell limit order with the retest entry. Now guys, stop loss is totally up to you, but if we used a totally fixed stop loss, so the same stop loss for each entry, let's say whatever pips you wanna choose, then we would see which would be the best of those in this specific occasion. And in this occasion, the sell limit order would be the best. But remember guys, this is only in this occasion. This might differ from occasion to occasion and from currency pair to another currency pair. Now, one final thing. Each one of these strategies has its advantages and disadvantages. There's no one of them that I would say is better than the other, because some will work perfectly in specific points in time and also in specific currency pairs, and others will not. All you can do is go ahead and backtest each and every one of them on all different currency pairs that you want to be trading, and then according to your own backtesting results, choose which one of these entries suits you best and on which currency pairs. One thing is universal for all of those entries. We want to see an established uptrend or downtrend. Then we want to see something like a flag pattern, and then we can be considering one of these things. For me, an extra confirmation, guys, for sure, it's for the price to be below the 50 EMA if I want to be selling, or above the 50 EMA if I want to be buying. But if you have an established uptrend or downtrend, then you will be above or below respectively, that's for sure. That's gonna do it for today, guys. Please like the video and subscribe to my channel for more free educational content, and if you want to support the channel, I will be leaving my links down in the description. Thank you all for watching, until next time.